Do you want to be able to buy stocks at a discounted price and get paid for doing so? Watch this video. I'm going to be talking about the sell put strategy. So in this video, I'm going to be sharing with you what a sell put option is, some of the things to watch out for, and I'll be sharing with you an example of how to place the trade. So what is a sell put option? A sell put option is essentially you're obligating yourself to purchase 100 shares of the underlying stock at a predetermined price you set, which is usually lower than how much the stock is trading at today, and at a specific time in the future. And by doing that, you're going to be collecting a premium or income from the buyer of this option. That sounds too good to be true, right? So I'll be showing you why you should or should not write a sell put contract. So the reasons why you might want to write a sell put option is when you're slightly bullish on the stock, or when you think the stock is going to be trading flat, or if you want to just generate some extra income. If you're super bullish on the stock, you might as well just own the stock outright. Because with a sell put option, you might never even own the stock. Because for you to be assigned the stocks, you have to be in the money at the time of the expiration, which means that the stock price is below your strike price. The strike price is a price that you determine when you write the option. And for you to be able to write a sell put option, you would need to have a cash collateral for this. So for example, if you're gonna do a sell put on Apple stock, right now Apple is trading at $180. So you will need to have $18,000 in your brokerage account in order to go ahead and write this sell put option. And so for some of the reasons why you don't want to write a sell put option is if you think that the stock will drop a lot in value, or again, if you think that the stock will go up in value significantly over the short period of time. And another thing is that when you're writing a sell put option, make sure it's a stock that you're willing to own 100 shares of, in case it does get assigned to you. Also, if you're new to sell put options, I would also recommend against going with a stock that is too volatile, because although they do pay more in premium, but they also can lose a lot of value. If you do get assigned the stocks, you're essentially agreeing to buy a stock at a predetermined price you set. So let's just say that your strike price is $100, and by the time it expires, the stock fell to $60. But you're still going to be obligated to buy the stock at that $100. So I would definitely recommend going with a more stable stock at first if you're just starting out. If you're more proficient later on, then you can try other different stocks. But you definitely want to buy good companies with good fundamentals for this to work, because essentially you're bullish on this stock. But with that said, I think that there's still a lot of opportunities for you to be able to enter to buy a sell put option. There's still a lot of good companies that have dropped a lot in value due to the recent inflation and the rate hikes. So let's go ahead and jump to my screen and I'll share with you an example. So here on my screen, just got this new Disney sell put option here. And this was executed, let's see, on June 6th. At a strike price of $90 and expiration date of June 23rd. And the premium I'll be receiving for writing this contract is $98. So as you guys can see that there's the cash collateral right here of $9,000. So this is the cash you must have in your account before you go ahead and place the sell put option here. And the reason I picked Disney as the underlying stock is right now is trading at $92.50. It's because it's really a great company and it is something that I don't mind owning 100 shares of. So it met the criteria of writing a sell put option. And it also has really good fundamentals. So this is a website I like to come to do a quick analysis. It is called macrotrends.net. I like to use this site because it's really easy to use. It has a lot of the key ratios I need to look at here and all the financial all in one place. But you can also go ahead and use Yahoo Finance or Bloomberg to do your research. But for this, let's look at the income statement real quick. So as you guys can see, for the revenue, it's trending upwards and looking very healthy. Actually, in 2022, it had an all-time high at 82 billion, which all these numbers are all in millions. Let's see, quarterly. The quarterly is looking pretty good as well. Gross profit is also looking good. EBITDA is looking good. Another thing I like to look at is the balance sheets. Just wanted to see that it is growing and is consistent. There's nothing too major going on here. And if we look at the cash flow statement, cash flow from operating activities is generally positive. It took a hit, I think, during COVID. This is way down from back in 2018. But I think now that it's open, more and more people are going back to Disney. So I think it will be doing better for the future. So as you can see that the net cash flow is negative. That probably explains why the stock had dropped in value so much. And I also like to take a look at the P ratio here, which is price to earning ratio. The lower, the better. That means that the stock is undervalued. Right now, it is at 27.95, which is considered pretty good for a stock like Disney. If you look at a stock like Amazon, that P ratio is going to be way off. It's going to be 147, which is ridiculously overvalued. So it definitely depends on different companies and different industries as well. And other thing is, if you look at the technical analysis here, there is a strong support. I'm looking at the 5-year chart here. There is a strong support right here. This is back in 2020 for 85.98. So we're pretty much at the bottom here. So I believe there's a strong support right here around $90 level. And that is why I placed the strike price at $90. I do own more Disney stocks in my other portfolio too. But this portfolio, I'm just really doing the put option and call options. And also, I think that Disney stock right now is undervalued, given that the all-time high is at $197. So now I'll go ahead and show you how to place a sell put option. I'll go and click on the option chain. And first things first, you will go ahead and click on sell put. And if you're using other trading platforms, you're going to click on sell to open a put option. Basically, you're opening a new option and it's going to be a sell put. And for the expiration date, I do like to have around 30 days. It's really up to you. You can do weekly option contracts or you can do longer. I like to do 1 month because it is more passive. The weekly option does give you a little more premium if you trade more frequently. So let's just use July 7th as an example. So you'll see right now the stock is trading at $92.50. So for sell put options, you generally want to choose a stock price that is below, and that's how you're going to get a discount for buying the stock. So one thing I like to look at is a delta between 0.2 to 0.3. So delta, I think of it as like a deviation from its current trading price, from the $92.50. At $92.50, you'll see the delta is close to 0.5. If it is out of the money, it will be closer to 1. So let's go ahead and go with the $90 example here, because I do think that Disney stock will not fall below $90. So there's going to be 3 scenarios. Let's start with the worst case scenario. So let's say by July 7th, the stock fell to $80. I'm still obligated to buy the shares at $90, even though I can just buy on the market for $8,000. So my loss would be $1,000 there. That would be the worst case scenario. But I'll also be keeping the premium. In this case, it's $116 in premium. That will protect against my loss. So again, that reinforces why you want to be slightly bullish on the stock if you want to do sell put option. Now the second scenario, which is the best case scenario, is if it falls right below $90 at expiration, which means I get to keep 100 shares of Disney at $90. Plus, I get to keep the premium, which is what I want in the first place. That would be the best case scenario. Now, the third scenario is if, let's say, it goes up to $100 at expiration. That wouldn't be as good for me as well, because if I had owned 100 shares of Disney, then I would have made $1,000 profit. But at the same time, I'm also keeping the premium no matter what. So I'm basically betting against the stock going below $90 by expiration. So then that's why I'm saying that when you write a sell put option, you're really not going to be super long term and not super bullish on this stock. Otherwise, you would just own the stock instead. So is it worth it? It's going to depend on everyone and what your goals are. Like for me, this is going to be just to generate income. And also at the same time, I don't mind owning 100 shares of Disney at $90. So, which is fine for me. It gives me a little buffer protection instead of buying the stock directly at $92.50 today. I have a chance to buy at $90 and earn some extra income. So let's take a look at the annual return for writing this sell put. Let's say it's $116 of premium per month and multiply by 12. That's $1,392 divided by the amount of capital I have invested, which is $9,000. So I'm getting around a 15% return on this. Compared to putting in my savings account for about 4% right now, this is much better. And I'll be making another video on the best savings account out there right now. But like I said, I'm not complaining about this 15% return. This is pretty good. Another thing you want to look at is the implied volatility. It is at 23%, which is relatively low compared to stocks like, if you look at Tesla, and let's take a look at the options. Sell put for 28 days. And again, let's compare apples to apples. It was around delta of 0.3%. Let's go with 220 here. Yeah, you're going to get $700 in premium, but your implied volatility is 53.65%. But because it has a much higher volatility, it's going to give you a higher income as well. So, I mean, you can do it if you really believe that $220 is a good price to pay for Tesla. But for me, I'm more conservative and I'm focused on consistent winnings. Plus, I have other portfolios where I own Tesla stocks outright. And by the way, if you guys got some value out of this video so far, make sure to hit that like button for me and subscribe for more videos on investing, because I spend a lot of time making these videos. It'll be much appreciated, and I thank you for your support. So now let's go ahead and pretend I'm going to be placing a trade here at $90. So go ahead and click on here. So for number of contracts, go ahead and put 1. Depends on how many numbers of contract you want to own. And for the limit price, I like to go at least ask price 1.2. I like to go with 1.30 for this example here. It is going to take longer to get filled, but again, I'm more conservative, so I'd rather get filled at a better price, because I know at the time when I'm about to place the trade, it's not going to be the best price available. So I like to always give myself a little bit of buffer here. Usually it will get filled. And for this, I'll be getting $130 for premium, which is a little higher. But I would recommend everyone to go at least for the ask price, because in the long run, this is a good habit to have. It's going to save you so much more money. And investing is all about getting the best price, right? And finally, I just want to recommend everyone to do this as well. Once your order is executed, you want to come back in here and click on the trade. and you want to go ahead and buy to close the sell put option. And because I bought this at 0.98, I'm going to do 10% of that, which is going to be 0.09. And you want to select good till canceled. And again, the whole point of doing this is that you want to close out your options early. So because in this case, if the stock price of Disney goes up significantly, and what's going to happen is that the value of your contract is going to go down. You sell to open at first, but now you have to buy it back. So I want this to execute if I've gained the majority of my income already, which is about 90%, because I don't want to risk if the stock falls back down to $90 by the time this expires. All right, so that's pretty much everything I want to tell you guys about writing a sell put option. If you guys find this video helpful, please click that like button. Stick around for more videos like this. If you guys have any questions, leave it in the comments down below. Thank you guys so much for watching, and take care.